Morning, everyone. So we're going to try this again today. So apologies for yesterday. Hopefully everyone can hear us. If you want to go ahead and type in something on the questions, just to give us a heads up that you can hear us. We believe we're in good shape here. So once again, my name is Brad Shively with the Capital Management Corp. Thank you for joining us today, Thursday, November 7th. Capital Management Corp is pleased to have Tim Call, Chief Investment Officer, and Mark Livesay, Portfolio Manager, here to discuss the third quarter and our long-term outlook. We will have a few brief slides. We're hoping to keep this to under 15 minutes and then have Q&A after that. So please be sure to type in your questions in this section here where it says questions. And thank you for the response there that essentially everyone can hear us today. Before we get into the slides, just a few brief remarks on the markets where we are at today. We've seen recent fresh optimism take hold as major indexes have reached all-time highs in the past few days after spending much of the late summer and early fall drifting along in a narrow range driven by concerns of inverted yield curves, trade wars, and expectations for poor corporate earnings. This past Wednesday, the Federal Reserve cut interest rates for the third time this year, signaling it would likely leave rates unchanged near term, barring a sharper than expected economic slowdown. Also, trade war tensions have cooled in the past couple months, reassuring the broader markets. In Q3, earnings have seen mixed results, yet overall corporate earnings have been stronger than most investors or media members had predicted. Overall, our thesis from our Q2 webinar has played out as expected. Now I'll turn the call over here to Mark Livesay, who will walk you through the slides.
Thanks, Brad, and thanks everyone for joining. I'll just dive right in here to the slides. We have the first one is on the valuation of the market. This is something we always pay close attention to. Even if things are good, if stocks are overvalued, you can have bad investment results long term. So the overall takeaway is that most metrics are in line with historic averages. The PE ratio at the end of October at 17.2% or 17.2 times is right in line, a little higher than the 25-year average. The Shiller's PE or cyclically adjusted PE is pretty much in line. Dividend yield is pretty much in line. Price to book and price to cash flow is a little high, but not worryingly high. The one thing that is interesting is the earnings yield minus the BAA bond yield is positive, close to 2%. Typically, this is negative. So if that sounds like gobbledygook, what it means is typically you can earn more money on bond yields than you can on an earnings yield of a stock. And right now, that's not the case. So said one way, stocks are cheap relative to bonds. Said another way, bonds are expensive relative to stocks. Said even another way, given the level of interest rates, one could expect PE ratios to be much higher than they are today. So even though the market has set an all-time high, I think in 4 of the last 7 sessions, we do not see the overall market as overvalued. We do see pockets of overvaluation. However, we see pockets of undervaluation as well. In one note, this chart is the S&P 500. Of course, there's a lot more stocks that trade that are not in the S&P 500. The Russell 2000, which is a small cap index, hit its all-time high in August of 2018, so about 15 months ago, and has still not eclipsed that high. And we're about in the neighborhood of 9% below where we were there. So we actually think there's a lot of opportunity in small caps right now. So we feel okay about valuation, feel like stocks are cheap relative to bonds and nothing to worry about. The rest of the call, we're going to focus on the fundamentals. Not much has changed in a way from our outlook, but a lot has changed in monetary policy. The Fed, since our last call, has cut rates 3 times. So we had expected a rate cut, and I don't know if we would have expected 3 in a row at that time, but that's what we've gotten. The consumer remains very strong. We have a slide on that. We can go over why we think the consumer is strong and will continue to be strong. There's a lot of money not originating in the United States, coming into the United States for a number of reasons. Probably the biggest being bond yields are positive here, which is unique and unusual that it's unique, but it is unique right now. The trade war over the last couple weeks seems like there are room for improvement. Some of the tariffs might be lifted with China. The headline today that I think is leading to the market strength this morning. It's possible that we ratify the USMCA or the new agreement with Canada and Mexico, which would be a very big deal. And then there's innovative technology throughout the world that we're always focused on, trying to find companies that can benefit from these innovative technologies that they're developing. So the rest of them are just going to be kind of diving into these policies, one slide on each. I'm sorry, I went the wrong way. So on monetary policy, you can see that between 2008 and 2015, we were at a 0% interest rate. Starting in late 2015, the Federal Reserve increased rates and had 9 increases. And then this year, now we've had 3 decreases. So since the cycle began, we're kind of a net 6 up from where we were. But one thing to observe is the balance sheet is now growing again. The Federal Reserve is putting money into the system to help overnight rates, and the velocity of money, or the kind of the speed at which money changes hands, which is a very good economic indicator, has been up. Money supply in M1 and M2 are up 5.7 and 6.5% over the last year. So overall, monetary policy has gone from a little hawkish or less accommodative to more accommodative over the last 3 months, and the expectations have also been lowered. So on the chart, you can see the blue diamonds are what the expectations were at the beginning of the year or end of last year, and the brown diamonds are what they are currently, or as of their last meeting. So you can see that not only have rates come down, but the expectation of rates has also come down. And the long run expectation is for a 2.5% federal funds rate with a 2% inflation, so the real return on overnight money of 50 basis points. So overall, this is good for the economy. It's good for the dollar to not be quite as strong if you're an exporter. And part of the reason that the dollar had been so very strong this year was our monetary policy was a lot more hawkish than it relative to its peers throughout the world. Next, on the consumer, which I think is probably the biggest leg to the stool of our bull case, being 65 to 70% of the U.S. economy and doing very well, we just don't see a recession. So there's been kind of a tug of war between recessions coming soon, recessions not coming soon over the last, I'd say, 6 months, or actually probably beginning a year ago this time. And there were periods where everyone was convinced a recession was right around the corner, and then periods where people were less convinced. Right now, we're in a period where people are less convinced. We've remained less convinced that we're going to have a recession. So we think the economy will remain strong, and it's due to the consumer. Record employment levels, so people that want to work can find jobs. Consumer confidence is relatively high. Wage increases have been happening, accelerating. Interestingly, wage increases are faster at the bottom end of the scale than the top end. So the average worker is getting wage increases, and they tend to spend. And energy costs have been low and very stable. So we don't have that energy tax that we do sometimes when oil prices go up in a strong economy. So for the consumer, you have a job, your interest payments are very low, household debt service ratios at all-time lows, your house cost has stabilized, and if you refied your mortgage, your payment went down, or you are going to pay less interest because you shortened your term, and your net worth is at an all-time record. So it's really hard to quarrel with where the consumer is right now. So now I'll turn it over to Tim to take us home and talk about the foreign cash and trade talks.
So usually money is leaving the United States, quite prosperous country with a trade deficit, but we're seeing a huge amount of cash coming into the United States over the last year or so, but it continues. Part of that is because we have positive interest rates. On the bottom of this page, we see what the 10-year government bond rates are in different countries. And many of them are between 0 and 1%. In Japan, the 10-year bond is at a negative rate. And then if you put your money in banks in Europe, they'll charge you for your deposits and your balances on a recurring basis. So if you want to have a positive interest rate, you'll come to the United States and you say our interest rate is twice that of the UK and a multitude greater than these other countries, even greater than Greece's interest rate. So because of that, we see tens of billions, possibly hundreds of billions coming into the United States just to buy our treasury bonds, as we count as a reserve currency for when banks want to keep reserves with their central bank, but also any businesses or individuals who want a positive rate of return. The last tax law change had a big change for repatriation. So it used to be most U.S. companies would keep their foreign profits overseas because they didn't want to pay the repatriation tax, which was rather high. It became much lower, plus was mandated that you have to pay it regardless of whether you're bringing the money back. And then for future profits, moving to a territorial tax system. So that releases that money. There's no incremental penalty now for bringing it back to the United States. So as cash frees up overseas for these global companies, they can bring back money to the United States. So this could be between 2 and 3 trillion, plus all ongoing and future profits can be brought back as well. So this is a recurring item as well, that on an ongoing basis, we expect money to come back into the United States. Then on top of that, we used to send a lot of money out to buy energy. So we were the largest energy importer in the world. We're now, as of this year, the largest oil producer in the world. And on a net basis, we're exporting a little bit of energy. So that's a big turnaround from sending tens of billions and hundreds of billions overseas, mostly to the Middle East to buy their oil. Now we're taking in a little bit of money. So that's a big, big change. And that's good for our economy and our financial markets, that we have all this cash in the United States moving around, creating activity, helping the economy. So there have been a lot of worries about trade wars, and if there's anything negative, you'll hear a lot about it because it's more exciting if it's negative. So it used to be, how could you be so mean to your neighbors, Mexico and Canada? They're such nice people. So we heard about that for a long time, and then we stopped hearing about it because NAFTA 2 was agreed to by all parties, and Congress will probably pass this trade bill in the next 2 or 3 months. Because that's all good news and that will help the economy, we don't hear much about it. We do have lower metal tariffs on both Canada and Mexico already in place. We have a preliminary agreement with Japan agreed to in the last month. China might have a preliminary agreement with us before month end. And then we've won a judgment against the EU. This was a judgment regarding their subsidies on Airbus. This case is over 10 years old, and the U.S. recently pushed it at a little bit faster speed. So we finally have a resolution. We won the case. Now we can put tariffs on more European goods without retaliation. This gives us the upper hand in negotiations for the EU trade agreement and getting them to move a little faster on reaching a final agreement. And so that's the vast majority of the trade war issues. So we're closer to resolving all of them than creating them. And this is very positive news and will help global trade, but also the terms of the agreements should help the United States incrementally as well. You see on the right-hand side of the page how much different countries are dependent on exports. And it's color-coded how much in exports goes to each country. And even if you see a country doesn't have that much in exports going to the United States, they probably have, they're probably making goods that get sent to another country as an intermediary point where more value is added to the product, and then the finished product gets sent to the United States. So the United States being the largest consumer in the world and consuming almost half of all consumer goods in the world, we are the most important customer, and countries do not want to be in trade wars with their most important customer. So we've had the upper hand, and this is finally going to be a wind at our back instead of a headwind. And then we have all this good news on the economy. It is great on a top-down basis, but on top of that, we're seeing some great long-term opportunities and segments of the market. So in innovative technologies that will help all of us going forward. So we have biotechnology, which the advancements can extend our lives but raise the quality of life. And the smaller companies we have in this space don't pay dividends, the larger ones do. But we have some small companies. One just had its bone regeneration product approved. And so that's going to help a lot with people with knee damage. Their cartilage regeneration product comes out probably in a year. We also have companies that can treat cancer patients and other companies that can cure some diseases. And then cutting technology in the inflammatory diseases and your immune system. With lithium, this is what's needed for rechargeable batteries. And while we're used to rechargeable batteries in our power tools and cell phones and tablets, they'll be in cars as well. And it's a much larger battery for cars since they have to have a lot of power in order to not only last, but to give you speed and to go uphill. So as more electric vehicles get produced by more companies, they'll need more lithium. And we think the batteries of the future, the ones that will last longer and be more powerful and recharge better and faster, those require special pure lithium, lithium that's refined a little bit more. And it might be nuanced with other ingredients. We think only 2 or 3 lithium refiners or miners can handle this. And so we're very excited about those opportunities. And then with 5G, you have the technology and the infrastructure that needs to be built out before you go buy your handsets. If you buy a 5G phone, it will work on 3G and 4G. But the 5G is going to help you with a lot more streaming content, receiving data 20 times as faster and more reliable. So if you're a media company creating a lot of content, then that becomes more valuable because people can watch that on more of their devices real time without any interruptions. So there's the infrastructure build out, and that in that area we like battery companies as well as distributors. In the patent space, we've off and on owned different companies benefiting from that. We are very excited about one right now. It has software and the patents. And then with the content, there are a couple of companies that we believe have a great advantage there from a growth and a cost standpoint. All of the companies we're looking at in these areas are already very profitable and producing gobs of cash. We just think over the next 3 to 5 years, they have extraordinary opportunities that they can seize. So we're excited about those opportunities. And so we wanted to let you know that not only on an overall basis is the economy extremely strong, but there are pockets of opportunities. This one is, these are opportunities of growth. There are also several opportunities of value and deep value. And so we have a full plate and fully diversified portfolios that can take advantage of this.
Thank you, Tim. So in closing, while we do see opportunity for uncertainty over the 2020 election hitting consumer and business confidence in early 2020, as election day approaches, we believe uncertainty will decline as more people will think they know the outcome. By that time, inventory and adjustment headwinds should have abated, and economic growth could possibly continue, reaccelerate there at that point. That concludes the webinar. We will now take questions. And I'll just go ahead and dive in, but if you have any questions, please go ahead and type them into the area there on the screen under questions. You can just type them in. We'll answer them as they come in. First question we have, Elizabeth Warren is proposing a 37% capital gains tax, also a base of $450,000 adjusted gross income, at which time you would have to pay 37% on any unrealized gain on a stock. If inevitable happens, we have to live with this. We'll live with this. What is your best guess what the markets will do, and how would you restructure portfolios going forward?
People initially like who they vote for, so markets tend to go up after elections because you have certainty and you have who the people wanted. That's short term. Long term, when you increase taxes, it slows the economy and hurts the stock market. Of course, if you raise taxes, then it's more beneficial to have your transactions before the tax increase goes into place than after. So the strategy for portfolios would be to realize capital gains before the tax increases go into effect.
Yeah, one more note. The question was if the inevitable happens. I don't think it's inevitable that some of these policies that are being talked about in primaries will actually happen. Primary season, you tend to run to whatever side your party is. You tend to run to that extreme. And then in the general election, you tend to run back towards the middle. And then when you govern, it's a whole nother ball of wax because you have to deal with the House and the Senate as well that have their own elections, and you might not have the majority party in each of those. So although it's something to keep our eye on, I don't think it's likely that those 37% tax rates would actually become law. And as Tim noted, if they did, we would try to get out ahead of that and take gains while the rates are still lower.
All right, great. Next question coming in is, what companies will benefit most from 5G?
Well,
it's a good question, a complicated one. I guess it depends on which stage of 5G you're talking about. If you're thinking about the end of 5G, once it's already deployed and widely available, some of the consumer and some of the content companies are really going to benefit because they're going to be able to stream entertainment essentially very easily to cell phones, TVs, and things like that, and go over the top. So we've added some content companies here recently. Some pay dividends. They tend not to pay dividends. Another area where you would guess there'd be strength, which is traditionally dividend paying, would be kind of in the telecom space, where theoretically they could charge more because you're getting a better product, or they could gain share from. I'm talking about AT&T here, gain share from some of the lower players such as Sprint or T-Mobile. Of course, so that's at the end. Then you have the build out, which is ongoing, and for AT&T, Verizon, T-Mobile, Sprint, you're going to have a lot of money being spent. For a company like Disney, they're spending a lot of money now preparing their streaming application. So it's kind of spend up front and hopefully benefit down the road. Now, the way they're spending money, it will benefit a lot of the infrastructure players. So I'll toss it over to Tim to talk a little bit about that middle layer between when the companies spend and when it actually gets to the consumer.
So different companies create the technology, and then the industry has to come together and agree on the standards, and then give credit to those who created the technology and own the patents. And so one of our newer holdings, InterDigital, benefits greatly from that. And then when actually building out the network, you'll need distributors to provide the equipment. So they can provide value added too, and tell you which equipment's best and how to install it and whatnot, which is very helpful for the local company doing all the digging. So in that area, we do have Tesco Technologies. So as business ramps up, these companies should benefit greatly. Then on top of that, the actual equipment itself will need specialized batteries and encasements, and this will be basically every 3 to 5 blocks in a neighborhood. And Enersys creates that, and we believe they can service that as well on an ongoing basis. So that would be a huge increase in their overall business and I believe margins. So we have several names that we like in the area. Some have dividends and some don't.
Great. Next question. What does the European economy look like, and how will that affect the U.S. economy?
Well, right now, this is Mark. Right now, the European economy is growing slower than the United States, barely growing at all. There's a lot going on. I spoke to a CEO of a company we own last night, and they have a large business in Europe, and he was saying the Brexit uncertainty has really slowed things down, and Brexit will become less uncertain, or it will actually become certain, he believes, and the reports seem to believe by the end of January. So once that happens, I think the European economy can speed up a little bit. How it affects the U.S. economy is a tough question. I guess it depends on exactly what part of the economy you're talking about, but we don't do a whole lot of exports to Europe in general. So it doesn't have a huge impact on our economy if the European economy slows down or goes into recession. One thing that we have over them in spades is demographics. So our population is still growing, still younger people growing, whereas over there, their demographics aren't quite as favorable.
The next question is, what do you do with investors who are older and need more conservative portfolios? Some of them aren't making much money, and that's true. If you buy the 10-year U.S. Treasury, you'll be lucky to make 2% per year for 10 years. After inflation, that would be a negative rate of return, likely. But also, you're paying the full tax rate on that interest. So we think you'll lose wealth even before you spend money. So that's a pretty low return. we have growth and income stock portfolios that the dividend yields are twice as much as the yield of the 10-year U.S. Treasury. So it's odd to have stock portfolios yielding more than bonds. It's odder still to have a growth and income portfolio yielding twice as much as government bonds. And so with many of those underlying holdings increasing their dividends on an annual basis, we find that to be a very attractive spot for a larger portion of retirees' money. And that way, there's we believe, a high likelihood the principal will grow over time. And also the income, the dividend income, is tax advantaged, is taxed at a lower rate than interest.
Well, thank you today for your time, and a replay of today's presentation will be up on the CMC website at www.cmcva.com. Should be up later today, so we appreciate your time and thank you.